Did you hear the news? I'm about to send you the link, and wow, it's quite a revelation. Warren Buffett has made some massive stock sales. Warren Buffett, widely regarded as the greatest investor of all time, has recently been selling off substantial portions of his stock portfolio. Berkshire Hathaway just released its quarterly earnings report a few days ago, and if you take a close look at the numbers, something significant is definitely happening. By zooming out and examining Buffett's stock and bond holdings as of the first quarter of 2024, it becomes even more apparent. At the end of the first quarter, on March 31st, 2024, Berkshire Hathaway was holding a staggering $153.4 billion in short-term U.S. Treasury securities and a stock portfolio valued at $335.8 billion. A quick look at these figures shows that Buffett's portfolio was roughly 31% in government bonds and 69% in equities at that point. But fast forward just 3 months to June 30th, 2024, and things look very different. Berkshire now has a jaw-dropping $234.66 billion in cash, an enormous increase in just a single quarter. Where did all that cash come from? Almost entirely from stock sales. As of June 30th, Berkshire had significantly reduced its equity holdings from $335.8 billion to $284.5 billion. This means that within just 1 quarter, Buffett sold off at least $51 billion worth of stocks from Berkshire's portfolio, and that's not all. Once you factor in the $23.9 billion in stock gains reported in Q2, it becomes clear that he actually sold close to $75.5 billion in equities in just 3 months. So the big question now is, what exactly did Buffett sell and why? Some of you who follow Berkshire Hathaway closely may have already guessed it. The largest change in the portfolio came from the sale of just one stock, Apple. As we can see in Berkshire's most recent quarterly report, the company's holdings in Apple stock dropped from $135.4 billion to just $84.2 billion. That's a massive reduction of $51.2 billion in Apple shares. This reduction brought Apple's share of Berkshire's portfolio down from an impressive 50% 2 quarters ago to around 30% now. Despite this, Apple still remains the largest position in the portfolio, in fact, nearly twice the size of the second largest holding, Bank of America, which sits at $41.1 billion. But this major sale definitely alters the overall composition of Berkshire's stock holdings going forward. It's incredible, isn't it? This could very well be one of the biggest sales of Buffett's career. It's certainly one of the biggest headlines from this story. Now, to be fair, we did see Berkshire trim its Apple position by 13% in the first quarter. So we knew Buffett had started selling Apple shares. However, I don't think anyone anticipated that he would continue selling at this scale. Over $50 billion in just 1 quarter. That's truly remarkable. Now, the burning question is, why is Buffett selling? This is where things get really interesting. If you recall, when I was in Omaha covering the Berkshire Hathaway annual meeting, I made a video on this very topic because hearing Buffett speak live at the event was enlightening. During the meeting, he spent quite a bit of time explaining his reasoning behind starting to sell off his Apple shares. And as it happens, my entire trip to the US was made possible because. Let's talk about something exciting, your morning drink, and I've got some great news. The folks over at Morning Brew have generously agreed to sponsor this Berkshire Hathaway update. Many of you are probably already familiar with Morning Brew, but if you haven't heard of them yet, let me tell you, it's a fantastic resource. Morning Brew is a completely free newsletter that's delivered straight to your inbox every day, and it covers all the major headlines in the business world, breaking down how those stories impact your career, your investments, and even your everyday life. The best part? It usually takes less than 5 minutes to read, making it perfect for my morning commute to work. What keeps me coming back, though, is the way they present everything. It's written in a casual, fun, and engaging style. It's a hidden gem for anyone who wants to stay updated without feeling overwhelmed. I highly recommend joining the 4 million plus professionals who already subscribe to Morning Brew. It's free and it takes less than 10 seconds to sign up. If you're interested, you can sign up today by clicking the link in the description or the pinned comment below. Now, with that said, let's dive right into the burning question. Why exactly did Warren Buffett decide to offload a huge portion of his Apple shares? What's particularly fascinating about this story is that Buffett's reasoning is quite unexpected and gives us a lot of insight into where he thinks both the stock market and the broader economy are headed. One surprising takeaway from Buffett's comments is his rather nonchalant attitude toward paying taxes. He openly stated, "At Berkshire, we don't mind paying taxes. We're currently paying a 21% federal tax rate. Let the gains roll in." He even reflected on how not too long ago that rate used to be 35%, and in the past it's been as high as 52%. As he put it, the federal government owns a portion of the profits we generate. They don't own the assets, but they do claim a share of the earnings, and they can change that share at any time. Buffett went on to explain that while the current rate is 21%, with today's fiscal policies, something's got to give. He believes that higher taxes are likely in the near future. The government, after all, wants a bigger slice of your income, my income, and anyone else's income that they can claim. At some point, they might decide they don't want the federal deficit to grow any larger, which could lead to higher taxes down the road. And if they don't want to significantly cut spending, they'll need to take a larger percentage of the earnings that we all generate. Buffett's take is refreshingly pragmatic. With everything America has done for all of us, you shouldn't be too bothered by the fact that we're paying these taxes. He also mentioned that if Berkshire is paying a 21% rate this year, and perhaps a higher rate in the future, he doesn't think you'll mind that they decided to sell some Apple shares this year. Now, there's a lot to unpack from Buffett's explanation, but the core takeaway is that the primary reason for trimming his Apple position is his outlook on the future, particularly from a tax perspective. This tells us two key things. First, Buffett's broader view of the future of the United States, and second, how he sees fiscal policy evolving in the years to come. Let's start by discussing the future of America in light of Warren Buffett's recent actions, particularly his decision to sell a significant portion of Apple stock. From his comments, it's clear that Buffett sees the US heading toward a deepening deficit, one that's only expected to grow worse over time. He observes that the national debt is skyrocketing and interest expenses are climbing rapidly. In his view, when the situation eventually reaches a breaking point, which he believes is inevitable, the government will likely turn to higher taxes on both individuals and corporations as a solution. He has a point. Currently, the corporate tax rate in the US is just 21%, the lowest it's been since the 1930s. At one time, it was as high as 52%. However, over the years, it has steadily declined, eventually settling at the current level due to the Tax Cuts and Jobs Act of 2017. When you consider how much revenue the US generates from corporate taxes, it's just a small slice of the pie. So if the government gets serious about reducing the size of the deficit, raising the corporate tax rate seems like a pretty straightforward way to do it. This is why Buffett is content to cash in on a significant portion of the profits Berkshire has accumulated from its Apple holdings. By selling now, he locks in a 21% tax rate on those gains rather than risk facing a much higher tax rate in the future. This also gives us some insight into Buffett's outlook for future returns. For instance, imagine the corporate tax rate rises by 15% sometime over the next 5 years. If that happens, Buffett is essentially signaling that he doesn't expect Apple's stock to outperform the increase in tax rates. Instead, he'd rather cash out and park that 50 billion plus in US Treasury bonds, earning around 5%, rather than hold on to Apple for the ultra-long term. This is a highly unusual line of thinking from Buffett because it makes you wonder, does he believe Apple has lost its long-term growth potential? Has the company reached its peak? But here's where things get even more interesting. At the same meeting, Buffett stated that neither he nor his investment managers believe the economic fundamentals or the investment appeal of Apple have changed since Berkshire first invested in the company back in 2016. He even went on to say, "We haven't sold because we're pessimistic about the business itself." When Buffett and his team evaluate stocks, they don't view them the way most traders do. They don't look at shares of Apple, Coca-Cola, or American Express as just stocks. Instead, they see them as owning a portion of the business, the same way they view Dairy Queen or other wholly owned businesses within Berkshire Hathaway's portfolio. They don't attempt to predict short-term market fluctuations. They focus on picking businesses they believe in, and Buffett was clear that Apple remains one of those businesses. In fact, he stated that unless something truly extraordinary happens, Berkshire will continue to own Apple, American Express, and Coca-Cola well into the future, even when Greg Abel takes over as CEO. So this is where things get a little perplexing. On one hand, Buffett is selling off large portions of Apple stock, but on the other hand, he insists that his opinion on the business hasn't changed. Warren Buffett's recent decision to sell a large portion of Apple shares has left many wondering about his reasoning, especially considering his long-standing admiration for the company. In my view, this can only mean one thing: his decision to sell doesn't reflect any change in the quality of Apple's business. Instead, it speaks to the valuation of this extraordinary company. You can see this shift by examining Apple's price to earnings, PE ratio, when Buffett first started purchasing the stock back in 2016. At that time, Apple's PE ratio was around 12, meaning investors were willing to pay 12 times the company's earnings per share. What's fascinating, however, is that as Apple has continued to increase its profits, becoming even more profitable, the stock price has risen at a much faster rate than earnings growth alone would justify. This phenomenon is known as multiple expansion, where investors enjoy returns not only from rising profits, but also from the market's increasing willingness to pay higher prices for those same earnings. Today, Apple's PE ratio has ballooned to around 34, meaning investors are now paying nearly 3 times as much for the same level of earnings compared to when Buffett first bought in. This surge in valuation has outpaced the growth in Apple's underlying business performance, which is something Buffett alluded to in his recent comments. He mentioned that the stock market, in general, seems very expensive right now. Combined with the current economic uncertainties worldwide, Buffett doesn't mind locking in Apple's profits at a favorable tax rate and moving that money into cash or short-term investments. During the Berkshire Hathaway annual meeting, Buffett said, "I don't mind building up cash right now, considering the alternatives available in the stock market and what's happening globally. It seems like an attractive option at the moment." This statement reflects his view that the economic environment and the stock market's outlook aren't offering many compelling opportunities right now. In fact, when pressed on why he's holding so much cash, he simply said that he can't find better places to put it. This leads to an interesting question. Does Buffett think the entire stock market is overvalued? His ever-growing cash pile suggests he may believe so. According to Bloomberg, Berkshire Hathaway's cash reserves have now reached an all-time high of $276.5 billion, a staggering amount. For those unfamiliar with corporate finance, when large companies talk about increasing their cash reserves, you might not always see that reflected as a huge jump in cash and cash equivalents on their balance sheets. That's because significant amounts of surplus cash are often parked in US Treasury securities or other highly liquid, low-risk investments that aren't classified purely as cash. In Berkshire's latest quarterly filing, this is evident. When you look at the combination of cash, cash equivalents, and U.S. Treasury holdings from both its insurance and railroad divisions, the buildup is clear. Buffett's preference for these safe investments in today's volatile environment speaks volumes about his current mindset regarding risk and valuation in the stock market. In addition to energy holdings, Berkshire's significant short-term investments in U.S. Treasury securities bring the company's total cash pile to an impressive $276.5 billion. This substantial cash reserve comes at a time when the global and domestic economic landscape is fraught with uncertainty. We're witnessing a European land war in Ukraine, rising tensions between the US and China, and on the home front, inflationary pressures that have yet to be fully addressed. Interest rates are the highest they've been in decades, and recent job reports have shown lukewarm growth, signaling that unemployment could be on the rise. Meanwhile, the US deficit continues to worsen, further swelling the national debt. Despite these macroeconomic challenges, stock markets seem to be defying logic, reaching all-time highs, particularly in tech. Yet, it's mostly driven by companies like Nvidia, with many others struggling to generate meaningful revenue. It seems Buffett is assessing this complex situation and thinking maybe holding a large cash reserve isn't the worst idea right now, and that thought becomes even more rational when you consider that holding cash isn't as penalizing as it once was. For example, the yield on a one-month U.S. Treasury bill currently stands at 5.35%, which is far from the near-zero yields we saw just a few years ago. Cash, in this environment, isn't the dead weight it used to be. That's the bigger picture behind Buffett's significant reduction in Apple shares. He's opted to secure gains in an environment where cash is generating a decent return. And as always, I want to remind you, if you're interested in learning Buffett's strategies, step by step, including his 4-pillar method, how to analyze financial statements, and how to find intrinsic value using 3 different valuation approaches, be sure to check out the Introduction to Stock Analysis course linked below. You can also sign up today using the code *SAVE50* to get $50 off your registration. Thank you all for watching, and I'll see you in the next one.